Welcome back to another episode of Mission Control, the Bellwether Enterprise Podcast. I'm the host, Ryan Dentscheff. We recorded this episode a few months ago at the tail end of 2019 in our Bellwether office in Irvine, California. There have been some recent changes in the agency lending space, particularly as it relates to the FHFA's allocations to Freddie Mac and Fannie Mae. Joining the podcast to discuss some of these changes and what they mean for the big picture is Bellwether Senior Vice President Jason Krupoff. So yeah, I guess just jumping right into the conversation here, what's new with agency financing? Let's, get into that a little bit.
Well, Ryan, actually a lot has changed since the summer. There was a slowdown in August, and the agencies were basically reevaluating where they were in terms of their volumes that were nearing tapping out, given the low interest rate environment from the spring into the early part of the summer. So in August, they really slowed down. Come September 13th, the FHFA came out with an announcement of the new allocation of the caps for for the fourth quarter of 2019 and in the full year of 2020. So pretty big news. They announced that they would offer $100 billion of financing to each agency, Fannie Mae and Freddie Mac, for those 5 quarters that I just described. So this is good news for the borrowers, and the agencies are really back in full force, offering very competitive debt on fixed rate and floating rate money with general terms of 7 and 10 year financing terms is where they are usually the best.
So what kind of sparked all this kind of change? Like what was it that they saw that they wanted to make a change? Why, I guess, is the question.
Yeah, the FHFA wanted to change the fact that in the previous years they had allowed for cap exclusions. Mainly green financing would be considered a cap exclusion. So if the lenders were allocated in 2018 the ability to do $35 billion of debt, but anything that was green rewards or green building certificate, they would not count towards their allocation of their $35 billion. Hence, Freddie Mac in 2018 was able to do $75.5 billion, while Fannie Mae did about $65 billion. That was really the FHFA concluded that green financing wasn't meeting their mission target of providing affordable housing in the United States, and hence the change to the do away of exclusions and more just allocating each agency $100 billion, which again, considering that Freddie Mac did $77.5 billion in 2018, and Fannie Mae did $65 billion in 2018, being allocated $100 billion for 5 quarters is quite attractive, and there's a lot of dry powder to be placed between now and the end of 2020.
Gotcha. What main, products or what is really going to change or be, what are we going to see more of, I think maybe is the question.
Yeah, well, given the new $100 billion allocation, there is one caveat, and that caveat is that the agencies fund at least $37.5 billion or 37.5% of the allocation into affordable housing, and that can be traditional, capital A, of true affordable housing with regulatory agreements, etc., as well as mission-rich, little a affordable, which would be more qualified based on a certain percentage of AMI. And for example, a standard market is at 60%, a cost-burdened market is at 80%, a very cost-burdened market is at 100%, and an extremely cost-burdened market is at 120%. So therefore, if your property qualifies at one of those levels, depending on the county and city where you're based, the agencies are going to lean in because they're incentivized to do that business, because again, $37.5 billion of their overall year or 5 quarters needs to be allocated to that kind of product type.
Gotcha. And you kind of alluded to this a little bit earlier, just kind of what it means for borrowers right now and kind of the opportunities. I guess if we can go into that in a little bit more detail, just what you see big picture wise for, the next 5 quarters now with these new allocations and things like that, what all of it means for borrowers and how that kind of plays into what we're able to provide here at Bellwether.
Yeah, so the benefit to the borrower is if they have a property in one of those markets, and all markets across the country is segmented and defined, but just talking about general West Coast markets, if you have a property that's in there and you qualify, having rents that are considered affordable, little a affordable compared to the competitors, and the target is these are properties that are providing workforce housing to firefighters, police officers, teachers, etc. And if you have properties that qualify at those levels, the agencies are going to lean in because again they're incentivized they have to do $37.5 billion of their allocation to this kind of product type. So those borrowers with that property type is going to get the best spreads, generally speaking. Now, priority borrowers will also get extremely good spreads, but the agencies are certainly focused on the affordable workforce housing right now.
And then just lastly, if we can touch real quickly, just the idea of available homes and kind of like you mentioned, some of those workforce opportunities for school teachers and things like that. Do you really see some of these changes? How do you see that impact? Do you think it's really going to be able to kind of bridge the gap and provide more opportunity for these workforce type individuals?
I guess the idea is if borrowers' financing is more attractive than the market is, then they should be able to keep rents so just a slightly bit lower than other market properties, which means that the resident hopefully isn't spending more than 30 to 35% of their annual income on rent, which is kind of the national guide to being affordable, rents being affordable to their paycheck. Therefore, they'll have the ability to save more money or spend where they need to. That's the benefit to the tenant, and the borrower again is getting kind of better than market attractive financing.
Gotcha. All right. Well, I think that pretty much nails all of these this topic for today. Thanks again for sitting down with me. Happy to be here in Irvine, California, and sitting down here today. So thanks so much. Appreciate you.
Thank you for the time. Appreciate it.
Thanks.